Have you ever felt like the market was personally out to get you? Like every time you jump into a perfect setup, it instantly flips against you, leaving you staring at red numbers while wondering if your broker, the whales, or the universe itself is conspiring against you? If so, congratulations. You're not cursed. You're just human, and you've fallen into traps that even seasoned traders still stumble into. Here's the uncomfortable truth. Most accounts don't get destroyed by lack of knowledge. They get destroyed by predictable, repeatable psychological mistakes. Mistakes that happen in every market. Forex, crypto, stocks. Doesn't matter the asset. The traps are universal. And they're designed to feel right in the moment, which is why they're so deadly. In crypto, fake volume spikes trick you into buying the top. In stocks, breakouts without confirmation bait you into mistimed entries. In Forex, risking too much per trade quietly sets you up for a margin call. In options, overconfidence after a winning streak makes you reckless. And across all markets, ignoring correlations blinds you to hidden risks. Each of these mistakes is avoidable, but only if you're brutally honest about your own psychology. The paradox? The longer you trade, the more likely you are to step into these traps. Why? Because confidence grows, rules get bent, and humility fades. And that's when the market strikes. So in the next parts, we'll dissect each of these 5 deadly mistakes. We'll expose the lies you tell yourself, the illusions that feel safe, and the discipline required to dodge them. Because the question isn't whether these traps exist. The question is whether you'll keep falling for them. Let's begin. Crypto is the wild west of trading. It promises freedom, 100 times profits, and overnight millionaires. But behind the shiny altcoin charts and the tweets screaming to the moon, there's a darker truth. The game is rigged. And one of the oldest tricks in that rigged playbook is the fake volume spike. Here's how it works. Big players, call them whales, market makers, or just organized manipulators, slam volume into an asset out of nowhere. The candle rips upward, volume bars explode. Social media lights up with FOMO posts. This thing is breaking out. Don't miss it. Retail traders see the move and pile in, desperate not to be left behind. Then, just as quickly as it started, the pump ends. The whales quietly dump their bags onto the eager newcomers, and the chart collapses back to earth. Who's left holding the bag? You. If you've traded crypto for more than a week, you've probably seen this movie before. 1 minute, your altcoin is breaking resistance. The next, you're down 20%, wondering if you should hold, sell, or pray. And the cruelest part? It felt so real. The volume was there, the candle was clean, the breakout looked perfect. You weren't wrong, you were baited. Psychology explains why. This trap is so effective. Humans are wired to respond to urgency. Fake volume spikes hijack your fear of missing out. You see other people winning, and your brain screams, if you don't act now, you'll regret it forever. That urgency overrides discipline. Instead of waiting for confirmation, you chase. And chasing in crypto is like running toward a cliff. You don't realize it's there until you're already airborne. Professionals see it differently. They don't chase the first spike. They ask, where's the liquidity? Who benefits from this move? They look for footprints. Is the volume organic, spread across multiple exchanges, or is it concentrated in one shady platform? Is there news driving it, or is Twitter just echoing hype? Smart money watches, waits, and lets the amateurs rush in first. Then they trade the dump, not the pump. So how do you protect yourself? First, embrace skepticism. If a move looks too good, it probably is. Don't ask, what if I miss it? Ask, who's trying to trap me? That one shift in mindset will save you more money than any indicator. Second, learn to analyze volume with context. Not all volume is equal. Healthy breakouts are supported by steady, building interest over time. Fake pumps are sudden, vertical, and often fade just as quickly. Compare volume across multiple time frames. A single 5-minute surge means nothing if the daily trend is flat. Third, use patience as your weapon. Wait for retests. Let the first spike happen, then watch how price behaves afterward. Does it hold the level? Does it attract follow-through buying? Or does it immediately reverse? 90% of the time, patience exposes the trap. Finally, detach your ego. Fake spikes are designed to insult your pride. They make you feel like you're the only one not invited to the party. That emotional sting, everyone else is winning, why not me, is exactly what drives you to click buy at the worst possible moment. The pro trader flips that script. They take pride not in chasing, but in sitting out, because they know the market always offers another opportunity, while revenge against whales always ends in ruin. Let me be blunt. Fake volume pumps aren't going away. They are baked into the DNA of crypto markets. Why? Because they work. As long as retail traders keep biting, whales will keep baiting. Your job isn't to stop them. Your job is to stop yourself. Ask yourself, how many times have you bought a candle just because it looked explosive, only to watch it collapse minutes later? How many times did you tell yourself, this time is different, as you clicked buy on a spike? How many times did you ignore your plan because the fear of missing out felt unbearable? If you're honest, the answer is too many. And it will keep happening unless you change, unless you decide that missing a fake move is better than joining the wrong side of it, unless you accept that your edge comes not from speed, but from patience. The market isn't here to reward your FOMO. It's here to expose it. If you learn to recognize fake volume spikes, you flip the game. Instead of being prey, you become predator. Instead of being trapped, you watch others get trapped. And smile, because this time, it's not you. And once you've learned to dodge the illusion of fake crypto pumps, you're ready to face the next mistake, a trap that lives not in crypto, but in stocks. Because while fake volume spikes lure you in, chasing breakouts without confirmation pushes you out. And in volatile markets, that mistake can be just as deadly. Every trader dreams of catching the big breakout. That glorious moment when price explodes through resistance, volume surges, and you imagine yourself riding the rocket to financial freedom. You click buy, heart pounding, convinced you're about to bank the trade of the year. But then it happens. The price stalls, reverses, and dumps right back below the level. Your rocket turns into a falling piano, and you're the one crushed beneath it. Congratulations. You just became another victim of jumping into a breakout without waiting for the retest. Why is this mistake so common? Because breakouts are seductive. They look clean, powerful, undeniable. That green candle blasting through resistance feels like proof, like validation. Your brain says, finally, this is the moment I've been waiting for. But the market doesn't reward obvious moves. It punishes them. Here's the psychology. Humans hate uncertainty. When you see a breakout, your brain craves certainty. It wants to believe the move is real. And in that moment, discipline dissolves. You forget that most breakouts are fakeouts, that institutions often push price just far enough to trigger breakout traders before slamming it back down. Instead of thinking like a predator, you think like prey. And prey doesn't survive long in the jungle of volatile stocks. Professionals see it differently. They know the breakout itself is not the trade, the retest is. Why? Because a retest separates the fake from the real. If price breaks a level and then holds it on a pullback, that's confirmation. It shows that buyers are defending, not just attacking. It turns hype into structure. Without that confirmation, you're just guessing. And in volatile equities, guessing is the fastest way to turn gains into losses. Let's put numbers on it. Say a stock has resistance at $50. You see it break through on a surge, and you buy at $50.50. Feels good, until price wicks to $51, reverses, and slams back to $48. You're down 5% in minutes. But imagine if you'd waited. Price breaks $50, pulls back to $50, and holds. Buyers step in, volume confirms, and then you enter at $50.25. Suddenly your entry is backed by evidence, not emotion. That tiny shift in discipline can mean the difference between being trapped in a fake out and riding the real move. Why don't traders wait for retests? 2. Words, FOMO, and impatience. You think, If I don't get in now, I'll miss it. But what are you really missing? Most breakouts fail. By waiting, you're not missing profit. You're avoiding losses. The retest is not a delay, it's a filter. It weeds out the noise so you only catch the signal. And here's the sarcasm. You wouldn't buy a house just because someone walked past it, right? You'd check the foundation. You'd inspect the plumbing. But in trading, the moment you see a candle poke above resistance, you're ready to throw your life savings at it without asking a single question. That's not trading. It's gambling dressed up as analysis. So how do you fix this trap? Step 1. Rewrite your rules. No retest, no trade. Simple. Tattoo it on your trading journal if you must. Step 2. Redefine success. Your job is not to catch every move. It's to catch the moves with high probability. Missing a fake breakout isn't a failure. It's a win. Step 3. Master patience. Waiting for retests is boring. It feels slow. But boring and slow is what pays. The legends of trading aren't adrenaline junkies. They're monks with charts. Let me give you a story. A trader I once knew made $15,000 in a week by catching clean breakouts. He thought he'd cracked the code. The next month, he lost $40,000 chasing breakouts that never confirmed. Why? Because he believed the move itself was enough. He treated every breakout like gospel. The market punished him until he learned the hard way. The retest is where the truth lives. This mistake is magnified in volatile stocks. Equities are driven by emotion, headlines, and herd mentality. A news release, a rumor, or a social media post can spike price temporarily, only for it to collapse once the hype fades. If you jump on the first candle, you're playing hot potato with hedge funds. If you wait for confirmation, you're playing chess while everyone else plays checkers. Ask yourself, how many times have you bought a breakout only to watch it instantly reverse? How many times have you felt like the market hunted you? And how many times did you swear, next time I'll wait for confirmation, only to repeat the same mistake? That's the definition of insanity, doing the same thing, expecting different results. So let me challenge you. The next time you see a breakout, sit on your hands. Don't touch the mouse. Wait. Let the market prove itself, because if the move is real, you won't miss it. And if it's fake, you just saved yourself money, stress, and regret. The market doesn't reward speed, it rewards patience. Don't be the trader who jumps at shadows, be the trader who waits for the truth. And once you master the art of waiting, you'll be ready to tackle the next deadly mistake, the one that silently drains accounts across Forex, risking too much on a single trade. Because while breakouts lure you in, oversized risk blows you out. And if you don't respect the 2% rule, the market won't just hurt you, it'll erase you. If revenge trading is the emotional bomb and chasing breakouts is the rookie's trap, then risking more than 2% of your account on a single trade is the silent killer. It doesn't make noise, it doesn't feel dramatic in the moment, but it quietly sets a timer on your account, and sooner or later that timer goes off. And when it does, you don't just take a loss, you take a blowout. Let's break it down with math. Suppose you have a $10,000 account. If you risk 2% per trade, that's $200. One loss? No problem. 10 losses in a row? Painful, but survivable. You're down $2,000, but you still have $8,000 to fight another day. Now imagine risking 10% per trade, $1,000. One loss stings. 2 in a row, you're down $2,000. 5 in a row, you're down half your account. And here's the kicker. To recover a 50% loss, you don't need 50% back. You need 100%. The math works against you. The more you lose, the harder the comeback becomes. That's why risking over 2% is not just risky, it's suicidal. So why do traders do it? Ego and impatience. You tell yourself, I trust this setup. This one is worth going big. Or worse, if I just double my risk on this trade, I can make back everything I lost. That's not strategy, that's gambling. And the market loves gamblers. It eats them for breakfast. Even seasoned Forex traders fall into this trap. After a hot streak, they convince themselves they've earned the right to go big. They up their lot sizes thinking, I can't lose now. And then the market humbles them with one swift move that wipes out weeks, sometimes months of progress. Overconfidence meets oversized risk, and the account evaporates. Here's the professor's perspective. Risk per trade is the only thing you can actually control. You can't control the market. You can't control the news. You can't control random price spikes. But you can control how much you put on the line. And if you blow that one variable, nothing else matters. Here's the coach's perspective. Discipline and risk management is what separates survivors from casualties. Pros don't get excited about huge wins. They get excited about consistency. They know the game is not about hitting jackpots. It's about staying in the arena long enough for their edge to play out. And your edge doesn't need to be perfect. A system that wins just 50% of the time can make you rich if your losses are small and your winners are big. But if your losses are massive, even a 70% win rate won't save you. And here's the storyteller's perspective. I've seen traders blow entire accounts in hours because they risked too much. One guy risked 20% on a single EUR-USD trade, convinced his analysis was flawless. One tweet later, the euro spiked against him, and his $25,000 account was gone in less than 10 minutes. He didn't just lose money. He lost his confidence, his discipline, and, eventually, his career. Risking over 2% per trade is like driving a car without brakes. Sure, you can go fast, for a while, but eventually a curve comes, and without brakes, you crash. The 2% rule is your brake pedal. It may not feel glamorous, but it keeps you alive. So what's the fix? First, commit to the rule. Write it down. Tattoo it in your trading plan. Never risk more than 2% of your account on a single trade. Period. Not 5%. Not 10%. Not just this once, because the moment you break it, you're handing the market the keys to your account. Second, size correctly. Use position sizing calculators. If your stop loss is 50 pips away, adjust your lot size so the loss equals 2% or less. Don't move the stop to fit your greed. Adjust the size to fit your risk. Third, focus on the long game. One trade doesn't make you. 1 month doesn't define you. Trading is a marathon, not a sprint. Survival is success, because if you survive, you give your edge time to play out. If you don't, you become just another casualty in the Forex graveyard. And let's be sarcastic for a moment. If you really love risking 10% per trade, here's a shortcut. Withdraw your money, set it on fire, and save yourself the time. At least then you'll know exactly when you're broke. So let me ask you, how many times have you risked more than you should, telling yourself it was worth it, only to regret it? How many times did one bad trade erase weeks of discipline? And how many times did you swear you'd never do it again, only to repeat the same mistake? That's not trading. That's self-sabotage. The pros know this. Risk management isn't optional. It's the foundation. Without it, nothing else matters. With it, even mediocre systems can thrive. So here's your challenge. From now on, never risk more than 2%. Test yourself. See how it feels to lose small and keep going. At first, it'll feel boring. But one day, you'll look back and realize that boredom is what saved you. And once you master risk, you're ready for the next trap. The one that doesn't show up on charts but inside your mind. The trap of overconfidence after a winning streak. Because if oversized risk kills you fast, arrogance after victory kills you quietly. And trust me, it's just as deadly. Confidence is good. Overconfidence is fatal. And nothing feeds overconfidence faster than a winning streak. You nail a few trades in a row, maybe an options play that prints money overnight, and suddenly you feel unstoppable. You're not just a trader anymore. You're a genius, a market wizard, the next Warren Buffett with a dash of Elon Musk. The charts bend to your will, the Greeks whisper in your favor, and every click of the mouse feels like destiny. That's the moment the market sharpens its knife. Here's the trap. Overconfidence after a few wins. It doesn't take much. 3, 4, maybe 5 consecutive wins, and your brain rewires itself. You stop seeing risk. You start seeing inevitability, and inevitability is the most dangerous illusion in trading. Why? Because wins release dopamine, the brain's reward chemical. Dopamine makes you feel invincible. It tricks you into thinking you've cracked the code. You loosen your rules. You size up. You ignore red flags. In options trading, this gets especially brutal. A trader who just doubled their account on a few lucky calls thinks, why not triple it with even bigger contracts? The next trade goes south, and suddenly half the account evaporates. This isn't theory. It's a pattern as old as markets themselves. Jack Schwager's Market Wizards interviews are filled with stories of traders who got crushed after their biggest wins. Why? Because victory breeds arrogance, and arrogance blinds you. One trader admitted, "Every big drawdown in my career came after a winning streak." That's not coincidence. That's human nature. Let's dramatize this. Picture a trader who buys weekly Tesla calls. They hit 3 winners in a row, doubling their money each time. They feel like gods. The 4th trade, they go all in. But Tesla gaps down on earnings. Implied volatility crushes the contracts, and overnight they lose everything. Not most of it. Everything. The lesson? Success doesn't just inflate your account. It inflates your ego. And an inflated ego is the most fragile thing in the market. Here's the professor's take. Overconfidence skews probability perception. After a win streak, you think the odds are in your favor. But probabilities don't care about your last trade. Each trade is independent. The market doesn't know you deserve another win. It doesn't care. It just is. Here's the coach's take. Discipline is tested most not during losses, but during wins. Can you stay humble when you're hot? Can you stick to your rules when everything inside you screams, press the advantage? That's the real exam. Champions aren't made in recovery from loss. They're made in restraint during success. And here's the sarcastic storyteller's take. If you really want to experience overconfidence, go to a casino, hit a few lucky rolls at the craps table, and see how quickly you convince yourself you're a math genius. Spoiler, you're not. And the house will remind you brutally. Trading is no different. So how do you fight this trap? Rule number 1, size down after a win. It sounds counterintuitive, but pros do it all the time. One veteran said, "The moment I start feeling invincible, I cut my position size in half." Why? Because humility is easier to enforce mechanically than emotionally. Rule number 2, journal your emotions, not just your trades. After a win streak, write down how you feel. Do you feel cocky? Do you feel impatient? Are you tempted to skip setups because you already know what's coming? Awareness is the antidote to arrogance. Rule number 3, remember reversion. Wins cluster. Losses cluster. Streaks happen, but they don't mean anything about the future. If you win 5 times in a row, your probability on the next trade hasn't improved. In fact, your discipline risk has gotten worse. Rule number 4, define victory as following your plan, not just making money. If you stick to your rules and lose, that's still a win. If you break your rules and make money, that's actually a loss, because it plants the seed of arrogance. Options traders especially need this lesson, because options magnify both wins and losses. A 100% win can seduce you into risking more next time. A 100% loss can destroy you in one shot. That leverage of outcome makes discipline non-negotiable. Let me ask you straight. How many times have you had a hot streak only to blow half your account on the very next trade? How many times did you promise yourself you'd stay humble only to double size out of confidence? And how many times did the market humble you harder than you thought possible? If you're honest, you know the answer. And that's okay, if you learn. The pros didn't become pros by avoiding mistakes. They became pros by respecting the lessons. They realized overconfidence isn't a sign of strength. It's the beginning of blindness. So next time you feel invincible, do the opposite of what your ego says. Don't size up. Size down. Don't rush in. Step back. Don't declare yourself a genius. Remind yourself you're a student. Because in this game, humility is protection, and arrogance is exposure. And once you've mastered that lesson, you're ready for the final trap, the one that ties every market together. Because it doesn't matter if you trade Forex, crypto, or stocks. If you ignore correlations, you're driving blind. And the crash will come faster than you think. The markets are connected. That's the truth nobody likes to hear, because it ruins the fantasy that your trade exists in a vacuum. You want to believe your crypto long is safe because Bitcoin is its own asset class. You want to believe your stock trade is isolated from global news because this company has strong fundamentals. You want to believe your Forex pair moves independently because the chart looks clean. But reality doesn't care about your fantasy. And the harsh reality is this: ignoring correlations can destroy your account faster than any bad setup. Here's how it works. Bitcoin tanks 5% overnight. Suddenly, NASDAQ futures gap down. Tech stocks bleed. Risk sentiment across the globe shifts, and your safe EUR/USD long gets hammered as the dollar strengthens. You scratch your head. Wait, why is my Forex trade reacting to crypto? Because you forgot the golden rule. Markets don't move in isolation. They move in ecosystems. And ecosystems don't forgive ignorance. Professionals know this instinctively. They track not just the asset they're trading, but the assets around it. A crypto trader watches the S&P. A stock trader watches bond yields. A Forex trader watches oil and commodities. Why? Because money flows. Risk-on flows boost crypto and growth stocks. Risk-off flows boost the dollar and safe haven assets like gold or bonds. If you ignore these connections, you're basically playing chess while only looking at one piece. And while you're admiring your knight, the queen takes your king. So why do traders ignore correlations? Laziness and tunnel vision. It's easier to stare at one chart and pretend it's all that matters. It's comforting to believe the story starts and ends with your asset. But markets are global. Liquidity shifts like tides, pulling everything with it. Pretending otherwise doesn't make you disciplined, it makes you blind. Let's make it concrete. Suppose you're long Tesla stock. Looks great on the chart. But at the same time, Bitcoin is dumping, dragging risk sentiment with it. NASDAQ futures turn red. By the time the market opens, Tesla gaps down 4%, and your perfect setup is underwater before you even sip your morning coffee. Was your analysis wrong? Not exactly, but your awareness was. You ignored the broader picture. Or take Forex. You're short GBP/USD because the technicals look weak. But you didn't notice that US inflation data is due, which will affect the dollar, and that gold and oil are already flashing risk-off signals. The report hits, the dollar surges, and your safe trade turns into a bloodbath. Again, not because your setup was terrible, but because you ignored the correlation web. Here's the professor's perspective. Correlations aren't static. They shift over time. Sometimes crypto leads stocks. Sometimes stocks lead crypto. Sometimes oil drives Forex pairs like USD/CAD. Sometimes bond yields drive equities. The relationships aren't fixed, but they exist. And you need to study them. Not obsessively, but attentively. Because ignoring them is like ignoring the weather before sailing. You might have a sturdy boat, but you're still doomed in a storm. Here's the coach's perspective. Stop being lazy. Build habits that track the big picture. Every morning, check futures. Look at the dollar index. Watch crypto if you trade stocks. Watch commodities if you trade Forex. You don't need to predict everything. You just need to know the environment you're trading in. Discipline isn't just about stops and entries. It's about awareness. Here's the sarcastic storyteller's perspective. Ignoring correlations is like wearing noise-canceling headphones while walking across a busy highway. You might feel peaceful, but the truck is still coming. So how do you protect yourself? Rule number 1, know the drivers. In crypto, watch equities. In equities, watch bonds and macro news. In Forex, watch commodities and central banks. Every asset has a cousin that whispers clues. Rule number 2, build a dashboard. Don't trade with one chart open. Have a quick glance setup with indices, crypto majors, bonds, and commodities. 10 seconds of scanning can save you from 10 hours of pain. Rule number 3, accept that no trade is isolated. The second you put money into the market, you've entered the global liquidity pool. Stop pretending your asset is special. It's not. Rule number 4. Use correlations to your advantage. If you see Bitcoin pumping while Nasdaq futures rip higher, that's a stronger signal for risk-on assets. If you see gold and bonds rally while stocks crumble, risk-off is in play. Align your trades with the tide instead of swimming against it. Ask yourself, how many times have you taken a trade that looked flawless on the chart, only to watch it collapse because of random global moves? How many times did you curse manipulation, when in reality you just ignored the bigger picture? And how many times did you promise yourself you'd pay attention, only to get tunnel vision again? The market doesn't punish ignorance immediately. That's why this trap is so deadly. You might get away with ignoring correlations for a while, but sooner or later, the global tide shifts, and if you're not watching, you drown. So here's your challenge. Tomorrow, before you trade, scan the big picture. Ask, what's risk on, what's risk off, and how does it affect my asset? Train your brain to think ecosystem, not isolation, because if you learn to respect correlations, you stop being the pawn sacrificed by bigger players. You start thinking like them. And that's when you go from being hunted to being hunter. And once you've mastered this final trap, you're ready for the last step. Because avoiding mistakes isn't just about saving money. It's about transforming your identity. In the final summary, we'll tie everything together and show you how dodging these traps doesn't just make you a better trader. It makes you unshakable. So here we are. We've walked through 5 of the most dangerous traps that destroy traders across Forex, crypto, and stocks. Not exotic setups, not rare black swan events, just everyday mistakes, the kind that feel natural in the moment, but lethal in the long run. Fake volume spikes in crypto trick you into buying tops, handing your hard-earned money to whales who laugh as they dump on you. Jumping into breakouts without retests seduces you into chasing green candles in volatile stocks, only to get slapped by fakeouts. Risking more than 2% per trade in Forex quietly guarantees a blowout account, because math doesn't forgive recklessness. Overconfidence after a winning streak in options blinds you to risk, making you press harder just when you should ease back. And ignoring correlations between markets, thinking your trade lives in isolation, leaves you exposed to tidal waves you never even saw coming. Each trap looks different, but the root is the same: psychology. You don't lose to the market, you lose to yourself, to your greed, your fear, your impatience, your arrogance, your laziness. The market doesn't care about your plans, your hopes, or your needs. It reflects you back at yourself. And that's the hardest truth of all. Now here's the paradox. These mistakes are universal. Everyone makes them, even pros. The difference is that professionals learn from them, while amateurs repeat them. Pros get burned once by fake pumps, and next time they wait for confirmation. Pros get faked out once on breakouts, and next time they demand retests. Pros learn the pain of oversized losses, and next time they respect the 2% rule. Pros taste the bitterness of arrogance, and next time they size down after a streak. Pros see how markets flow together, and next time they trade with the tide, not against it. That's the real lesson here. It's not about being perfect. It's about evolving. Every loss is tuition. Every mistake is feedback. The market will keep teaching the same lesson until you learn it. And once you do, you don't just protect your account, you transform your identity. Let's put it bluntly. Trading is not about making money. It's about survival. If you survive long enough, the money comes. But if you treat every trade like a lottery ticket, you won't last. The graveyard of blown accounts is filled with traders who refuse to learn discipline. So here's your challenge going forward. Don't measure success by today's profit and loss. Measure it by whether you avoided these traps. Did you resist chasing that pump? Did you wait for the retest? Did you stick to your 2% rule? Did you check your ego after a win? Did you consider correlations before pulling the trigger? If the answer is yes, even if the trade was red, you won because you practiced discipline. And discipline is the only edge that never decays. Trading is not a straight line to wealth. It's a dojo, a place to train, to fail, to grow. Every chart is a mirror, Every trade is a test. Every mistake is an invitation to become stronger. You don't rise because the market is easy. You rise because you become unshakable. One day you'll look back and laugh at the mistakes that used to wreck you. You'll remember the times you chased volume, blew accounts, sized up recklessly, and ignored the bigger picture. And you'll smile, not because you're proud of the losses, but because you know they forged you. They burned away the gambler. They revealed the traitor. So, let me ask you the final question. Who are you becoming? Are you going to keep being the trader who blames the market, who chases, who gambles, who collapses at the first storm? Or are you going to become the trader who survives, who adapts, who thrives, not because the market gave you a gift, but because you earned it through discipline? Remember this, your next trade isn't just a position, it's a decision about whether you repeat the same traps or rise above them. The market doesn't want you to win, it wants you to learn. And if you do, then you don't just win trades, you win yourself.